Hello dear CMA aspirants from South India. As you all already know, Akash Agarwal Classes has launched for you all 100% English lectures in English for CMA Foundation students giving their examination in December 2025 and onwards. So here I am going to tell you how do you enroll in the batch. You just have to join our WhatsApp community which is given in the link. Fill up the Google form again given in the link and to download our mobile application Akash Agarwal Classes to access the notes. You all know the lectures which we are going to conduct will be 100% covered. There would be no subject which we are not taking care of. So we are going to take care of each and every subject, each and every concept. We are going to take MCQs for you. We are going to provide test papers. We are going to take live mentee sessions as well. Lectures which we are going to take for you all are 100% recorded lectures and not dubbed lectures. And you all know we have exclusive team ready for you all to teach you for your CMA Foundation December 2025 attempt for subject wise as well. And we are uploading the lectures on a weekly basis. All the important links which will be useful to you all are uploaded in the description box. Since we have many students who have cleared CMA examination at all the levels from Akash Agarwal Classes, and to reciprocate the love which we have received from South Indian students, we are here for you all taking lectures 100% in English, so that we can clear your CMA Foundation December 25 attempt together. So keep studying, do watch all the lectures till the end, and do show some love by liking the video, subscribing to the channel, and putting up a word in the comment box. Keep studying. Bye-bye.
Hello everybody, how's everyone? Let's start with our another session. Welcome back to Akash Agarwal Classes. Today we will be covering the second topic of our paper number 2, fundamentals of accounting, that is accounting principles for concepts, conventions and principles. Basically this topic is very important because it will be giving you approximate weightage of 2 marks or 4 marks. Generally high chances will be of 4 marks, but the minimum will be 2 marks. Very important chapter. Similarly, in the previous session we have covered the frameworks of accounting, which will also carrying approximately 2 to 4 marks in your exams. Now sir, what do you mean by frameworks of accounting? Explain us that. What is the framework of accounting? And you have done with the framework of accounting. Tell me what are the basic concepts that we know in accounting. See over here, one of the main objective of accounting is to help the users. You have to help the users to take appropriate decisions by providing relevant accounting information. When you have provided relevant accounting information to your users, then the users can take decision that they have to invest the money or not to invest the money. For this purpose, accounting maintain records of each and every transaction in the books of accounts. The practice of this record keeping, however, may be based on diverse policies at various organizations. As a result, there is limited scope of comparing accounting information across entities over the time. Many entities follow respective accounting principles. So it is very difficult over the period of time to compare the financial statements between two different types of entities. In order to ensure uniformity and consistency in record keeping and to produce accounting information which is largely comparable, to ensure uniformity between the different type of business organization and consistency in record keeping, and the most important thing, to compare the financial statements, the accounting professions has developed some rules. There are some rules, there are some conventions, there are some standards, and there are some procedures which are generally accepted and universally practiced. It means that every businessman, each and every businessman who are doing business will follow the basic rules, concepts, conventions, as well as standards, as well as procedures for the purpose of comparison. The common set of rules, conventions, standards and procedure is referred to GAAP, that is generally accepted accounting principle. Very, very, very important point. Generally accepted accounting principle. Common set of rules, conventions, standards, procedures is known as what? Dash. Generally accepted accounting principle. Sir, why generally accepted accounting principle? Sir, why gap? In order to ensure uniformity, to compare the financial statements, GAAP was brought. Generally accepted accounting principle. There are some set of rules, procedures, standards, some conventions that you have to follow. The GAAP provides the guidelines for reporting economic events and thus are used by the organization in drafting the financial statements. These are followed by the organization so that the users of accounting information have an optimum level of consistency in the financial statements. Then, over here, just give me a second. They use while comparing such information over a period of time and across the entities for the decision purpose. Such accounting principles have been developed from research, adopted accounting practices, and pronouncements of regulators. In India, financial statements are prepared on the basis of accounting standards which are issued by the Institute of Chartered Accountant of India and the law laid down in the respective applicable statutes, that is Schedule 3 of Companies Act, is required to be followed by all companies. This accounting standards as well as rules prescribed under various statutes have the GAAP at their core. GAAP at their core. So it means GAAP. I have done with the definition of GAAP. It is a uniformity to compare the financial statements between two organizations. It is a common set of rules, some procedures, some standards, some conventions which will be helping the users to take a optimum level of decision for the purpose of investment. Accounting principles refer to those rules, actions which are universally adopted by the accountant for recording accounting transactions. What are dash refer to those rules of actions that are universally adopted by the accountants for accounting transaction. Accounting principles, they provide the guidelines for recording and reporting transactions and such provides explanation to the current account practices. Accounting principles are further classified into two things. So this can be also asked for an MCQ. Accounting principle, what do you mean by accounting principles? They are universally adopted by the accountant for the purpose of accounting of transactions. Now, accounting principles are further classified into two things. The first one is accounting concepts and second one is accounting conventions. First, we will be getting about the concepts. Then we will be going to conventions. Accounting concepts refer to the assumptions and conditions that define the parameter and constraints within which the accounting operates. They determine the parameter and the constraint. Accounting concept will determine the parameter and constraint within which the accounting operates. They lay down the foundation for accounting principle and to ensure recording of financial fact on sound basis and logical consideration. The common accounting concepts include, there are some common accounting concepts. Let's go one by one on the accounting concept. The first is business entity concept. Sir, what do you mean by business entity concept? For example, this is Mr. A and this is Mr. B. Or let's go ahead. CB sir. That means your Chaitanya sir. CB sir business. Now, CB sir and CB sir business are two different persons. CB sir is an individual and business is another person. It is artificial person. It is created by operation of law. CB sir and CB sir business are not the same person. Which concept states that? Business entity concept. What do you mean by business entity concept? Owner and the business are two separate persons. When we will be doing the accounting, we will be doing the accounting from the point of view of the business and not from the point of view of the owner. It means that here CB sir and CB sir business is both the different person. We will be doing the accounting from the point of view of CB sir business and not from the point of view of CB sir. The most important thing, that's why hope you will have studied 11 12 standard to 11 plus 1 and plus 2. In 11 and 12 you must have prepare a balance sheet over here. Here we have to write capital, right? But liability, we are writing capital under the head of liability because it is a money invested by the owner. It is money invested by the owner which the business has to return back. Which the business has to return back to the owner when the business winds up. When the business winds up. The important thing, that is the reason capital is shown under the head of liability. Due to which concept? Business entity concept. Owner and business are two separate persons. When we are doing accounting, we are doing accounting from the point of view of the business, not from the point of view of owner, as per which concept? Business entity concept. Now come over here. This concept states that accounting purposes, the business enterprise and the owner are two separate independent entities. Thus, the business and personal transaction of the owner are separate. For example, owner has purchased a TV for his house. So it is owner's personal transaction. Owner has purchased a TV to be installed in the reception of the business. It is a business transaction. So we have to record only business transaction, not owner personal transaction. Owner personal transaction will be recorded in the owner personal books of accounts. Owner invests money in the business. It is recorded as a liability of the business. Similar, when the owner takes away from the business cash or goods for his personal use, it is not treated as business expense. For example, when the owner takes away some goods, some cash from the business for his personal consumption, personal use, it will be not a business expense. It will be owner personal expense. It will be treated as a drawings. Therefore, we deduct drawings from capital. For example, owner has invested 1000 rupees, but he has also withdrawn 200 rupees. So net amount payable to owner will be how much? 800. Due to which concept? Business entity concept. I hope so each and everybody has been getting clear. Ki what do you mean by business entity concept? Owner is different and business is different. While doing accounting, we have to do the accounting from the point of view of the business, not from the point of view of the owner. The second concept is what? Going concern concept. It means that life of the business is infinite. Members may come, members may go, but life of the business is infinite. I will be giving you a practical example over here. Just come over here. Going and searching Tata Group. I hope so everybody know Tata Group. Here I go on Tata Group on the Wikipedia. See over here. The business has founded in 1968. It has been 157 years ago. Still the business is going on. Due to which concept? Going concern concept. It was founded by Jamshedji Tata. But today Jamshedji Tata is not in between us. Then also the business is going on. Due to which concept? Going concern concept. Accounting assumes that the business will continue to operate for a longer period of time in future. In other words, it is assumed that neither there is intention nor any necessity to curtail the business operation of the entity. What do you mean by curtail? To minimize, to reduce the business operation. It is on the basis that the financial statements of a business entity are prepared and referring to which investors agree upon the decision to invest in the business. It means that going concern means what? Members may come, members may go, but life of the business will be infinite, and you don't know beta. Going concern concept is a fundamental accounting assumption as per accounting standard 1. As per accounting standard 1, going concern concept is an fundamental accounting assumption. One more important thing from the point of view of MCQ, we classify as fixed asset and current asset due to going concern. Due to going concern concept, we classify fixed asset as well as current asset. The very important thing, you must remember it. Going concern concept, members may come, members may go, but life of the business is infinite. Two concepts I have completed. The first one is business entity concept. The second one is going concern concept. Third one will be what? Periodicity concept or accounting period concept. Periodicity concept or accounting period concept. In the above concept, we have read that the life of the business is infinite. Members may come, members may go. But in this concept, the life of the business is infinite. We know that we have allocated the life of the business into regular intervals of 12 months for the purpose of accounting. The most important thing, accounting period concepts assume that the infinite life of the business can be split into smaller periods of equal durations. Generally it is 12 months, but it might be quarterly. Quarterly means how many months? 3 months or 4 months? You must remember, quarterly means 3 months. Half yearly means 6 months, and yearly means 12 months. The life of the business is infinite. We have allocated the life of the business. We have split the life of the business into regular intervals of 3 months, 6 months, or 12 months. Due to this, the operating results are uncertain for a specific period. Due to this concept, we prepare profit and loss account as well as balance sheet. The financial position is reflected through the balance sheet at regular interval. Due to which concept? Accounting period concept. It can be asked for a MCQ. Due to which concept we have to prepare profit and loss account every year? Accounting period concept or periodicity concept. Very important point. You don't have to forget it. Let's go ahead. 3 points we have completed. Going concern as well as business entity, and last one was accounting period concept. Now next one is money measurement concept. What do you mean by money measurement concept? In a business, those transactions which you can measure in terms of money or money is worth, only those transactions will be recorded. Otherwise, the transaction will not be recorded. For example, I have the smartphone. I also have a laptop. I also have a car. But this all things are in quantity. But if I told my mobile phone is valued at 1 lakh rupees, my laptop is for 1,50,000 rupees, and my motor car is for 20 lakh rupees, then it can be recorded in the books of accounts. Money measurement concept. A business transaction will be always recorded if it can be expressed in terms of money. Only the business transactions are recorded if it can be expressed in terms of money. The advantage of this concept is that different types of transaction could be recorded as homogeneous entries with the money as common denominator. A business may own 3 lakhs in cash, 50,000 kg of raw material, 10 vehicles, 3 computers, etc. Unless each of this is expressed in terms of money, we cannot find out the asset of the business. When expressed in common measure of money, transaction could be added or subtracted to find out the combined effect. In the above example, we could add the values of different assets and find out the total asset. If I have told you that I have 3 computers, I have 5 laptops, I have 3 air conditioner, I have 2 mobile phones, so you cannot determine the value of my asset. But when I told you that I have 3 computers of 1 lakh each, that is 3 lakhs, I have 4 laptops of 20,000 each, 80,000. So my value of asset will be how much? 3 lakh plus 80,000 will be 3 lakh 80,000. That will be showing as money measurement concept. Only those transactions you have to record which you can measure in terms of money or money is worth. We know what do you mean by money. We also know what do you mean by money is worth. So simple thing. It is not difficult. We are done with the fourth concept. The first one was business entity. The method of teaching I do cumulative revision every time of the students. That is the reason many students have scored a very good marks in CMA foundation as well as CMA intermediate as well as CMA final. Here are some results of our CMA foundation student scoring out of 400, 386, 380, 382, 378, and all the students have further scored all India rank in CMA intermediate as well as CMA final. So just a suggestion to you all to study well, to be motivated, to watch the lectures and to give update. Also we will be adding a WhatsApp community link in the description box. You have to join the WhatsApp community, stay updated. We both will be helping us to clear the exams in a very flying colors. So just what you have to go with the flow. Let's go ahead. The accrual concept. There are some bases of accounting. I will be first explaining that. What do you mean by basis of accounting? There are firstly three bases. The first one is cash basis. Second one is accrual basis. You must note down this. Third one is mixed basis. Sir, what do you mean by cash basis? What do you mean by accrual basis? What do you mean by mixed basis? Just look over here. Cash basis means only cash transactions. It means that you have to record an income or you have to record an expense only when actual cash is received or paid. When the actual cash is received or the actual cash is paid, then only we have to record the transaction in case of cash basis. Cash basis tell us record the transaction only when the actual cash is received or the actual cash is paid. Accrual basis only cash transaction. Cash received or cash paid. However, here, accrual basis means you have to record cash transactions plus credit transactions. Cash transactions plus credit transaction. Cash transaction plus credit transactions. It means that it is also known as mercantile system of accounting. Basically, all the business organization follows accrual basis only. Because cash transactions plus credit transaction, it means that you have to record the income when a right to receive is generated. And you have to record the expense when obligation to pay arises. We have to record the income when right to receive is generated and we have to record the expense when obligation to pay arises. It means that what do you mean by accrual basis? Accrual basis tell that if you have earned some income, irrespective whether it is received or not, we have to record. For example, I have sell you the goods of 10,000 rupees. You have made me the promise you will be giving me the money after 1 month. So I have the right to receive money from you. I will be recording this transaction in the books of account as a credit transaction. It is known as accrual basis. For example, I have taken your home for rent of 10,000 rupees. I will be paying monthly a rent of 10,000 to you. Now I stay in your house for 1 month. Then after 1 month, it is my obligation, it is my duty to pay you the amount. That is the main reason Accrual basis, also known as mercantile basis of accounting. The third one is mixed basis. It is combination of both. Cash plus accrual. Over here, what happens? You have to record the income on cash basis and expense on accrual basis. It means that you have to record the income only when it is received, and you have to record the expense when it is accrued. What do you mean by accrued? Irrespective the payment has been made or not. It means that salary is outstanding to pay. We have not yet paid the amount. It will be recorded in mixed basis. Income is yet to be received. Income is earned but yet to be received. It will not be recorded in mixed basis. It is known as mixed basis of accounting. So there are total three bases. The first one will be the cash basis. Second one will be the accrual basis, and third one will be the mixed basis. Cash basis tells us you have to record only cash transaction. You have to record the transaction when either cash is received or cash is paid. In accrual basis, it is also known as mercantile basis of accounting. In accrual basis, you have to record the cash transaction plus you have to record the credit transaction. Income is recorded when right to receive is generated and expense is recorded when obligation to pay arises. In case of mixed basis, it is combination of both cash plus accrual. Income should be recorded on cash basis and expense should be recorded on accrual basis. It means that income you have to record when it is received, and expense you have to record when it is incurred. That means obligation to pay arises. These are the bases of accounting. The accrual concept is based on the recognition of both cash as well as which transaction, credit transactions. In case of cash transaction, owner equity is instantly affected as cash is received or paid. In a credit transaction, however, a mere obligation towards or by the business is created. When credit transaction exists, which is generally the case, revenue are not the same as cash receipts and expenses are not same as the cash paid. Very important. When there is a credit transaction, revenue are not the same as cash received. It means that you have received 10,000 rupees of cash, but the revenue is 15,000. It will not be same, and the cash payment will be not same. The cash expenses will be not same as cash paid towards the year. For example, you have paid 8,000 rupees, but the expenses are 12,000 rupees. They are not same. As per which basis? Accrual basis. Next concept is dual aspect concept. What do you mean by dual aspect concept? Each and every transaction will be having two aspects. Each and every transaction will be having two aspects. One will be receiving aspect, another will be giving aspect. For example, Mr. Prabhas. I hope so. You all know Prabhas. Mr. Prabhas sold goods to Mr. Arjun. Prabhas sold goods to Mr. Arjun for 50,000 rupees in cash. It means that Prabhas sold the goods for Mr. Arjun for 50,000 in cost. From the point of view of Prabhas, goods sold, यानी कि goods are given. The first effect, or right, cash received. Second effect. From the point of view of Prabhas, there are two effects: goods sold, goods given. Income generated and cash is received. From the point of view of Arjun, from the point of view of Allu Arjun, goods received, cash paid. So each and every transaction will be having two aspects. One will be receiving aspect and another will be the giving aspect. Over here, in case of Allu Arjun, cash paid is giving aspect and goods received is a receiving aspect. In case of Prabhas, goods sold is a giving aspect as well as cash received is a receiving aspect. Over here, dual aspect concept is a foundation or basic principle of accounting. It provides that every basics of recording business transactions in the books. This concept that every transaction has dual effect, that is the respective opposite sides. Therefore, the transaction should be recorded at two places. It means that both the transactions must be recorded. For example, goods purchased for cash will be giving of cash and receiving of goods. These two aspects will be recorded. That only I have explained over here. Every transaction has two effects. If Prabhas has sold goods to Allu Arjun, so in the books of Prabhas there will be two effects. Goods have been sold, income has been generated, and cash has been received. From the point of view of Allu Arjun, goods have been received and cash has been paid. So these are the two important things that you have to remember. Thus, the duality concept is commonly expressed in the fundamental accounting equation. So what is the fundamental accounting equation? Assets is equal to liabilities plus capital. Assets is equal to what? Liabilities plus capital. Fundamental accounting equation is what? Assets is equal to liabilities plus capital. Over here, the balance sheet equation also forms because over here liabilities and capital is given and over here assets are given. So we can also tell the dual aspect concept is forming the accounting equation. Also, it is also known as balance sheet equation. This will be all the next concept. We are done with some 6 concepts. The first one is business entity concept, going concern concept, money measurement concept, accrual concept. Then we have go to accounting period concept, and then we have go to dual aspect concept. Till now, we have covered with approximately 6 concepts. Not approximately, exact 6 concepts we have done. Now the next concept will be matching concept. What do you know matching concept? You have read in the school. What do you know matching concept? You have do the match the following. I think so. Everybody has been solved the match the following. You have to match the correct pace. Over here, in case of accounts, you have to match the correct income with the correct expenses. For example, I'm just building an example for you all. For example, Mr. Keshav purchase 20 quantity of goods at 10 each. So how much is the expense? 20 into 100. You must have to take your calculator with you because without calculator you will be not able to solve the accounts. 20 into 10, it will be 200, right? He have sold 15 quantity of goods at 30 each. So 15 into 30, it will be approximately 450 rupees, right? Right? Now over here, 200 is your expense and 450 is your income. So every student who is giving the CMA foundation exam, whose basics are not clear, over here, from his or her point of view, 200 minus 450, 250 will be the profit, and that is the biggest wrong answer you ever give. Here the quantity is 20 and the selling quantity is 15. 5 quantities with me only. That means it is our closing stock. So we have to record the expense of only 15 quantity. Over here, if we go with 15 quantity of goods at the rate 10 each, it will be 150, and 150 minus 400 will be giving me a profit of 300, and the correct profit in the books of accounts we must record 300 and not 250. I hope so this example has been clear for matching concept. It is also known as revenue matching concept. You have to match the current year income with the current year expense. For example, some employees has been working with you since 2 months. You have not yet paid the salary to him. So you must record the salary in that accounting year only, not in the next accounting year. Just because you are paying the salary in the next year, it does not give you the right to record the salary in the next year. You must record the salary in the same year. Due to which concept? Revenue matching concept. Due to this, you can identify the correct profit of the business. This concept says that the revenue and expenses must be recorded at the same time at which they are incurred. In general, the revenue earned should be matched with the expenses incurred during the accounting period. For the application of this concept, several adjustments are made for prepaid expense, accrued income. So what do you mean by prepaid expense and what do you mean by accrued income? We will be discussing what do you mean by prepaid expense, what do you mean by accrued income. Now just I have tell you an example of outstanding expenses. Just like that, there are prepaid expenses, outstanding income. The operating result of an accounting period can be measured only when the incomes are compared with the related expenses incurred. When we have matched the expenses and income, then only we can find out the correct profit of the business. Here is our another concept, that is matching concept. After that, there is a concept known as realization concept. Which concept? Realization concept. In case of realization concept, it tells us that you have to record the income only when it is realized. You have to record the income only when it is realized. Example के लिए. So sorry, little bit I will be, come back to topic. Realization concept. Example, Mr. Iyer has contacted Mr. Jetalal for iPhone 18. Jetalal says to Mr. Iyer that I will be providing you with the mobile phone after 3 months when the mobile phone is launched. Mr. Iyer tells, okay, once the mobile phone is launched, kindly provide me with the mobile phone. Jetalal says, okay. Iyer says, I want to give this phone to my wife, that is Babita. So over here, what happened? When Jetalal received an order from Iyer, but Jetalal will be delivering the goods after 3 months when the goods have been received to Jetalal. So over here, it is a sale for Jetalal and purchase for Iyer. It will be not amounting to what? Realization. What do you mean by realization? Here, Mr. Jetalal cannot record the income of iPhone 18, that is, for example, 2 lakh rupees in the books, because Jetalal has not yet delivered the goods to Mr. Iyer or receive any payment from Mr. Iyer. It means that receiving an order does not amount to income, because it might be uncertain that after 3 months when Jetalal receives the phone, Iyer will be refusing him. Okay, I don't want the phone now. It might so happen. Therefore, the concept is known as realization concept. This concept states that revenue from any business transaction should be included in the accounting records only when it is realized. The term realization means creation of legal right to receive money. Selling goods is realization. Receiving an order is not. Here, Jetalal has been receiving an order from Iyer, but he has not yet delivered the goods. Accordingly, revenue is said to be have realized when cash has been received, or right to receive on cash or on the sale of goods or services has been created. Here, Jetalal has no right that he can ask the money from Iyer because they have not yet delivered the goods. So it is known as realization. It means that you have to record the income only in the books of accounts when it is certain and it is realized. The next concept is cost concept. Only 4 to 5 concepts are pending. Then we have completed with one more unit of our accounts 1.2. Cost concept. What do you mean by cost concept? Cost concept means that you have to record the asset at its acquisition cost, that is purchase price. Just give me a second. Yes, in this concept, you have to record the asset at its acquire price or its acquisition cost. It means that the price at which you have acquired the asset. Oh yeah, accounting cost concept states that all assets are recorded in the books of accounts at their purchase price, which include cost of acquisition, transportation, installation, and not at its market price. It means that assets are recorded in the books at their acquired price and not at their market price. It means that fixed assets like building, plant and machinery, furniture, etc. are recorded in the books at the price paid for them. For example, a machine was purchased by XYZ Limited for 5 lakh rupees. For manufacturing shoes, an amount of 1000 were spent for transportation the machine to the factory side. In addition, 2000 were spent on its installation. Over here, the purchase price of machine will be 5 lakh 3000. 5 lakh for the purchase, 2 lakh 1 lakh for the transportation, and 2 lakh for the installation. This is known as historical cost concept. Is that if business entity does not pay anything for acquiring asset, this item will not appear in the books of accounts. Which concept? Cost concept. So till now, which concept we have completed? The first concept was business entity concept, going concern, accounting period. Then we have studied about the next concept, that is basically money measurement. After the money measurement, we have gone on the accrual concept, matching concept, cost concept, realization concept, and one more concept we have read, that is known as dual aspect concept. Over here, the part of concepts has been covered. We are covered with the parts of concept. Now, just conventions are pending. Accounting conventions are customs, traditions associated with the practical application of accounting principle. They are widely accepted and they are common practice which are used as a guidelines when transactions are recorded. These have evolved over a time of different accounting practices. These conventions are also known as doctrine. The different accounting conventions are also known as doctrine. There are some customs and tradition association, application of accounting principles. They are widely accepted and are commonly used as a guideline when the transactions are recorded. 4 conventions are there: convention of conservatism, convention of consistency, convention of materiality, and convention of full disclosure. Let's go reading with the 4 conventions. We will be completing the topic. The first one is convention of conservatism. Very simple. It is also known as conservatism or prudence. It is also known as concept of prudence. It means that you have to record future anticipated losses. You have to record future anticipated losses, but not record future anticipated profits. Record future anticipated losses, but not record future anticipated profit. Concept of conservatism, yeah, it is known as concept of prudence. This convention is based on the principle that anticipated no profit but provide for all possible losses. It provides a guidance for recording transaction in the books of accounts. It is based on the policy to playing safe in regard of profit showing. The main objective of this convention is to show the minimum profit. Profit should not be overstated. If the profit shows more than the actual, it may lead to distribution of dividend out of the capital. This is not a fair policy and it will lead to the reduction in the capital of the enterprise. That is the reason concept of conservatism is applicable to almost each and every entity. You will be making the provision for future losses. For example, I have sell you the goods. You are my customer. I know that many of the customers does not pay the amount, it will be amounting to my bad debts. So I will be making a provision for bad debt, that is also we know as RDD, before they are incurred. It means we'll be recording all future losses but not future profits. Concept of conservatism. You have studied the closing stock is market at cost price, recorded at cost price or market price, whichever is lower, due to concept of conservatism. You have the convention of conservatism, concept of prudence. You have to record future anticipate profit, but don't record future anticipate loss. Accounting conventions. Very, very, very simple. Convention of conservatism. The second thing is convention of consistency. Consistency. What do you mean by consistency? You must follow the same accounting set of rules, same accounting methods which you have followed in the previous year. For example, in case of depreciation, you have followed SLM. What do you mean by SLM? Straight line method. It is a method of charging depreciation. In the second year, you are trying to use which WDV. It is not fair. It is not fair. It is not consistency. In case of consistency, what does consistency tell? Tells the convention of consistency means that same accounting principle should be used for preparing the financial statements year after year. A meaningful conclusion can be drawn from the financial statements of the same enterprise when there is a comparison between over a period of time. Why is there consistency? Because we have to compare the financial statements over the number of years. But this can be possible only when the accounting policies and practice followed by the entry funds enterprise are uniform and consistent over a period of time. If different accounting procedure and practice are used for preparing the financial statements of different year, then the result will not be comparable. For example, I have used SLM for first year, so I must use SLM for the next 4 years or next 10 years. I don't have to change the method. If, for example, for valuation of inventory, if I have used FIFO, that is first in first out, or I have used LIFO, that is last in first out. So what I have to do, I have to follow the same accounting procedure or method in the same year. We don't have to change the methods. The next two last point will be, first will be convention of materiality. The convention of materiality states that to make the financial statements only material effect. What do you mean material fact? Material fact or immaterial fact? What do you mean by material and what do you mean by immaterial? Just over here. For example, this is a stapler. Stapler I have purchased only once. It is an asset by nature, but we have to record it is an expense because it is immaterial. You will be not investing money in my company by seeing my stapler. We have not showing stapler in the books of accounts as an asset. We have always shows in the printing and stationery. It is immaterial. It is what? Immaterial. Same punching machine, calculators are immaterials. So those transactions which will have an impact on the decisions, which influence the decisions of the users, is known as what? Material transaction. For example, you have not recorded a furniture of 50 lakh rupees. So it is a material transaction. You must record the same because it will be helping the users for the purpose of decision. It will be influencing the decision of the users. So first one is material fact, second one is immaterial fact. Record which item? Material item. Ignore which item? Immaterial item. It means that stapler, punching machine, omission of paise. I have purchased some asset at 2 lakhs 1 rupees. So I am recording it at 2 lakhs. Or I have purchased an asset for 2 lakh 1 rupees 20 paise. So I am ignoring the paise because paise are immaterial. But rest of the amount is what? Material. So material or immaterial will be depending upon what? company to company. For example, for Reliance company, 5,000 rupees is immaterial, but for a small company like me, it is what? Material. So materiality depend upon company to company. Over here, the convention of materiality states that to make the financial statements meaningful, only material fact, that is important and relevant information, should be supplied to users of accounting information. The question arises that here is, what is a material fact? The materiality of fact depends upon the nature and amount involved. Material fact means information of which influence the decision of the users. It means that from the item it may influence the decision of the user. Convention of materiality. The last convention will be what? Convention of full disclosure. What do you mean by full disclosure? You have to disclose each and everything that you have followed. It means that the concept you follow, the principles you follow, the procedures you follow, the methods you follow, you have to disclose each and everything. If there is a contingent liability, what do you mean by contingent liability? It may happen, it may not happen, depending upon a future uncertain event. For example, you have filed a case on me. If I lose the case, I have to pay you 20 lakh rupees. So this information is relevant. You have to disclose the information. Now, I have not have an obligation to pay immediately. But if I lose the case, I have to pay you 20 lakh rupees. So I have to disclose the same. Convention of full disclosure requires that all material and relevant facts concerning financial statements should be fully disclosed. Full disclosure means that there should be full, fair and adequate disclosure of accounting information. Adequate means sufficient set of information to be disclosed. Fair indicates an equitable treatment of users. Full refers to the complete and detailed presentation of information. Thus, convention of full disclosure suggests that every financial statement should fully disclose all relevant information. You have to just remember this simple thing. Each and every relevant information you have to disclose. Every relevant information you have to what? Disclose. So here we have completed with the 4 important conventions. That is, first one is convention of conservatism, also known as prudence. Second one is convention of materiality. Third one was convention of full disclosure, and one more there was convention of consistency. There are 4 conventions. You must remember the name: conservatism, consistency, materiality and full disclosure. So over here our 1.2 has also been completed. This will be also carrying 4 marks. In the past examination it has been for 4 marks, so I will be writing for 4 marks only, and this also has been for 4 marks. So these 2 topics will be giving you approximately 8 marks in your exams, which will be helping you to clear the exams. Over here I have finished all the concepts and conventions of accounting. There are total how many basically concepts? There are total 8 concepts now. First one, business entity, going concern, accounting period, money measurement, accrual, dual aspect, matching concept, realization and cost concept. 9 concepts and 4 conventions. Total 13 conventions and concepts we have completed in this second session. I hope so the session was very beneficial to you all. So do let me know in the comment section if the session was beneficial, and do share the video and do like the video, and any queries do let me know. Till then, keep studying, and also kindly join the WhatsApp community available in the description box to get more updates regarding your CMA foundation exams. Till then, keep studying. Bye bye, take care.